The lowest yield ETF in this video is 8%. That's massive, and that deserves a like. My name is Raj. On this video, we talk about money. Remember, I'm not a financial advisor, and this isn't financial advice, but this is my personal top 7 monthly paying dividend ETFs for income. Let's get into it. Our first ETF is TSLY, also known as the Yield Max Tesla Option Income Strategy ETF, and it has a huge 59% dividend yield. Yeah, that's insane. Now, I know what you're thinking, Raj, how is this possible? Well, the folks at YieldMax have provided us with an ETF that uses covered calls. This means that the fund will sell options contracts and collect the premiums. This in turn is paid out to investors. You can do this as an individual if you own 100 shares of Tesla, but that'll run you close to $25,000 just to be able to sell one options contract, since options are based on shares of 100. And you have to manage the position yourself. You risk losing your shares if they get called away. With Tesla, you don't have to worry about any of that. You just buy the fund and collect the dividend. Now, with the YieldMax funds specifically, they use a synthetic covered call strategy, which means that they do not own the underlying stocks they write covered calls on like some other funds we'll talk about. YieldMax instead combines put options in addition to selling calls, which in practice mimics a traditional covered call strategy. Now, all that is going to cost you, and TSLY has an expense ratio of 0.99%, but given the dividend payout, I'm not really complaining. As far as holdings go, well, the fund really only holds options contracts, so there's not much to say there. But what we really want to know is how the fund is performing. With yields this high, it's pretty obvious we are on alert for a dividend trap, where the yield is high, but the fund overall is losing money. The thing to keep in mind here is the fact that covered call ETFs, by their very nature, are not going to capture as much upside as the underlying stocks would, and will capture the downside. The trade-off is income potential. This also means that the fund is going to take longer to recover from any significant downswings in price. So to be clear, this and all other ETFs in this video are higher reward, but are also higher risk, and you could lose money. Most investors are likely better off investing in more stable assets. So let's see how TSLY performed since inception. If you invested $10,000 in December of 2022, at the end of November 2023, your position would be worth $9,519 with dividends reinvested, which is obviously not impressive. The thing is, Tesla, at the same time that TSLY just hit the market, had a huge drop in price, and TSLY of course went down with it. If we adjust our backtest to start 1 month later in January of 2023, the overall position is up $13,980 with dividends reinvested. Here's a snapshot of the distribution so we can see the monthly payouts. So we can see that the monthly payouts can change significantly, but in some months approach and are even over $1 per share. Two key things here with this ETF. It is highly likely most Tesla investors did not buy into the fund when it was first introduced, so there's probably going to be a lot of investors that are very happy with Tesla currently. But it does also highlight the downsides of covered call ETF investing, especially YieldMax ETFs. If you can handle the ups and downs, these ETFs might be amazing investments, especially if you reinvest the dividends thanks to compounding. Or something you want to stay away from entirely, since inception, Tesla is overall down even with reinvesting the dividends. Personally, I own a small position in this ETF right now, and I also own our next ETF as well with an even higher dividend. Our second ETF is CONI, also known as the YieldMax Coin Option Income Strategy ETF, which has a dividend yield of, get this, 104%. The expense ratio of 0.99% seems kind of on the low end, all things considered. But in all seriousness, this yield is not likely to be sustainable, but still goes to show the power of covered calls on overall yield. So this ETF works the same way as Tesla, except it uses a synthetic covered call strategy with Coinbase stock instead of Tesla. So given the strategy, there's no holdings other than options, and with the limited history of the ETF, we won't get a lot of historical data. But the ETF has performed well, going up in value, with Coinbase doing well in recent months, and the dividend has increased significantly. Investing $10,000 in September of 2023 would now be worth $13,756 at the end of November November 2023. As you can see, the dividend history is limited, but so far each distribution has been over $1, and the one for December was actually $2 per share. Before we get too deep into the video, I recognize that I just threw out 2 ETFs with huge yields. If you're into that, be sure to smash the like button. Please don't make a rash decision and buy them solely based on what you saw in this video. Use this video as a starting point for further research with the intention of knowing exactly what you're getting into. That includes the pros, the cons, and the unknowns. No one knows the future, including me, and full disclosure, I own all of the ETFs mentioned in this video at the time of recording, with one exception, and I'll tell you why I don't own that ETF when we go over it. But specifically for Tesla and Coney, if Tesla and Coinbase drop in value, the covered call ETFs will likely capture all of that downside, and you should be comfortable with that risk before you buy it. No such thing as a free lunch. Our third ETF is FEPI, also known as the Rex Fang and Innovation Equity Premium Income ETF, and it has a dividend yield of 25%. Now, I know that's not as impressive as Coney or Tesla, but FEPI uses a covered call strategy on multiple large tech stocks, which means that investors can diversify their covered call strategy with this one ETF, instead of buying single yield max ETFs. In addition, FEPI also holds the underlying stocks and sells covered calls against them, and because the fund holds the underlying stock, it has the potential to capture more of the upside when the stocks do well. FEPI currently holds positions in Intel, Micron Technology, Netflix, Tesla, Google, Meta, Amazon, Broadcom, AMD, and Salesforce. This ETF is incredibly new, so the calculator doesn't even have data on it yet, but since inception, it's gone from $51 to $55 and has paid out 2 dividends, one in November 2023 for $1.15 per share, and one in December 2023 for $1.18. Some investors might not necessarily want to concentrate their covered call strategy into single stocks like with YieldMax ETFs, or concentrate them in a narrow group like with FEPI. So the next 2 ETFs on this list offer competitive yields, but have less concentration risks. Our fourth ETF is JEPI, and this is the JP Morgan Equity Premium Income ETF. It currently has a dividend yield of 8% and an expense ratio of 0.35%. JEPI uses covered calls to generate income for investors, and it does this using ELNs. An equity-linked note is effectively an agreement with another financial institution. This agreement allows for principal protection, but also allows for yield to be collected. There is much more to this, and I'll leave a link to a fantastic video that explains it in further detail. JEPI writes covered calls on its underlying holdings, which include Amazon, Microsoft, Intuit, Train, Accenture, Progressive, MasterCard, Adobe, Visa, and AbbVie. Since inception, a $10,000 investment would be worth $12,620 at the end of November 2023, and it's been paying out a regular dividend, generally speaking around 30 to 40 cents a month per share. Our fifth ETF is JEPQ, or the JP Morgan Nasdaq Equity Premium Income ETF. This fund, like JEPI, writes covered calls on its holdings through ELNs. It has a dividend yield of 10% and an expense ratio of 0.35%. Its holdings are going to be different from JEPI in the sense that its holdings are based on the Nasdaq. Top holdings for JEPQ include Microsoft, Apple, Amazon, Google, Meta, Nvidia, Tesla, and other options positions. A $10,000 investment in JEPQ from January of 2023 to the end of November 2023 would be worth $13,904, and it would have paid out somewhere between 30 and 40 cents a month per share. So all 5 of the ETFs we've talked about so far had high yields, consistent payouts, and each have their own unique upsides, but they all are not the best option from a tax efficiency perspective. This brings us to our 6th ETF, SPYI, also known as the NEOS S&P 500 High Income ETF. It has a dividend yield of 12% and an expense ratio of 0.68%. It writes covered calls on its holdings, but it does this through SPX index options rather than the underlying stocks themselves. Because of this, its options contracts are subject to more favorable tax treatment using 1256 contracts. Its holdings include Apple, Microsoft, Amazon, Nvidia, Google, Meta, Tesla, Berkshire Hathaway, and JP Morgan Chase. A $10,000 investment in September of 2022 would be worth $11,095 in November of 2023, and the fund would have paid out a monthly dividend ranging from 46 to 50 cents. And finally, our 7th ETF is truly the most unique out of all the income ETFs I've seen. It's SVOL, or the Simplify Volatility Premium ETF. In a nutshell, SVOL will short the VIX, which is a measure of volatility in the marketplace. Doing so generates a yield which is passed to the investor, and SVOL has call options in place to protect against spikes in volatility, protecting from the downside of things. But Be fully warned, this has never happened since SVOL's inception, so we don't know how it will perform when the next spike in volatility happens. This is one reason why I personally don't own it at the moment, but we'll be looking at its performance very carefully in the future. For now, I like my returns better with other options we mentioned, but I do believe this will be in my portfolio in the medium to long term. The fund has a dividend yield of close to 16% and has an expense ratio of 1.16%. Its current holdings are various bond positions and other income-oriented holdings, as well as VIX futures and protected positions for volatility spikes. If you invested $10,000 at inception, that position would be worth $12,371, and investors would have received monthly dividends of roughly 30 cents each. Alright, so for fun math, let's figure out how much we would need invested to make $12,000 a year or $1,000 a month in dividends from a balanced portfolio of all 7 ETFs we just covered. The average dividend yield for all the ETFs mentioned is 33%, and let's assume that the yield stays the exact same for all investments all year. That means we would need $36,363.63 invested to get $1,000 a month in dividends. Now that sounds fantastic, but when you dive into the world of income ETFs, you're going to want to know about ROC, or return of capital. This can help you determine if a fund is a yield trap, but you do need to be fully aware that seeing return of capital isn't necessarily a bad thing. You have to take into consideration overall returns to determine if an investment is in fact a yield trap. What an investor should know is that if a return of capital is reinvested, it lowers the cost basis of the investment. However, this can also mean that the investment is not generating income, so the fund has to pay out from cash on hand and you run the risk of losing money. But some funds can actually still be profitable and return capital. The way a fund pays a distribution on the back end is usually not made known regularly to investors, and sometimes because of accounting, the yield can be returned as a return of capital, which makes it more tax efficient, for example like SPYI. The best way to address this is by looking for interviews with fund managers, since they can provide answers directly to any particular fund, and of course look at the overall appreciation or depreciation of the fund itself and see if it makes sense overall given the market conditions. Alright, those are my top options for monthly paying income ETFs. Remember to consider the pros and cons before investing, because what we went over in this video is definitely high risk, high reward. I hope you found value in the video, and if you did, be sure to let me know by clicking the like button. Feel free to let me know your thoughts in the comment section down below. Subscribe for more content. Of course, thank you for watching, and good luck in the markets.